Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a fresh new week, and it's the week before, the happy festival of Diwali as well. So lots lined up in terms of interesting programming, content through the course of the next 5 trading sessions and beyond. I'm Prashant, with me. My colleagues Nigel and Reema is with us today. Guys, morning.
Hi, morning.
Hi, good morning. I think this weekend was a reminder, I can't say gentle reminder, but that the tariff risk is not dead, as of now. So Dow Futures is rebounded, but look at Asia, it's selling off fast and furious. So I think it promises to be a very interesting session.
Well, that's right. And we don't know whether taco is going to happen yet again, or this time he's going to stick to what he's saying, because there's been a lot of flip-flop just in the last 12 to 15 hours itself. So we'll have to see.
I know this morning I was thinking when I had to present it, I would go in the chronological order or go reverse order. So because both will work. But it's a lot of stuff to digest. And it's all kind of happened. The good thing, the silver lining in all of this is, as we if markets were trading the last 2 days, you'd know what to make of it. But as we come this morning, there is a little bit more clarity in terms of where this perhaps is going. So that's how I would look at it. Now, low volatility calm was broken by a tariff headline redux, right? I mean, markets were nice, absolutely oblivious of anything which was happening. Tariffs were ignored, what effective rate, etc. All that had kind of sort of faded into the background. And it was largely a very nice move, especially in the US markets and, of course, around the world. I mean, Europe was breaking out. Asia, of course, has done fantastically well, of course, with the exception of India. US-China clash at the forefront once again. So Trump basically said that he's going to impose new additional 100% tariffs on China with effect from 1st of November. He also basically said that critical exports of software, etc., are going to be banned. President Trump said this new 100% tariff, in addition to what is already there, is in response to China's rare earth restrictions. Now, China on Sunday, that is yesterday, put out a statement saying that its actions were in response to US's actions, which came a few days earlier. So, who started this entire thing? Both are saying, well, our action is response to your action. It's like chicken and egg. In any case, this morning, there seems to be a bit of walk back, a little bit of, sanity. So President Trump's post on Truth Social appears to kind of walk back on his threat of this 100% tariff. That's essentially the post that I want to highlight. And he says, don't worry about China. It will all be fine. Highly respected President Xi has just had a bad moment. He doesn't want depression for his country, and neither do I. The US wants to help China, not hurt it. President DJT. So, this looks like he's not really... the hope is that this is the first step in perhaps de-escalation with regards to this 100%. It's like, what was that tariff, right? 140%, it doesn't matter, because at 100% no exports will happen. 140, 200, you can take it to 500, doesn't matter. And the additional new 100% tariffs are just disasters. So the hope is, with what we've seen with President Trump posting this morning, that perhaps he's appearing to walk back on his tariff threat. The one thing which I think is very clear, which Reema also highlighted, is that this tariff complacency was kind of exposed with Friday's sell-off. And the interesting thing is, and the complacency was there, right? The rare earth restrictions, China's rare earth restrictions came on the 9th of October. Markets didn't move. They just kind of ignored it. They only reacted when Trump reacted to China with his threat. And by the way, the markets reacted to the threat. The actual 100% announcement came after US markets shut. So this is the reaction to the threat. On Friday, sharp sell-off. S&P had its worst day since April. It was down 3%. NASDAQ was down 3.5%. Russell 2000 was down 3%. WIX, as I said, was very low volatility, nice trending higher market. It jumped 32%. So big one. You had oil prices which fell 4%. Yields sold off 10 basis points in the 10-year. Dollar index was down 0.6. The entire shebang, basically, the entire macro complex reacting, moving in one way like it used to around the Liberation Day, etc. But since then, it looked like the markets have kind of sort of moved on and put all this tariff, etc. behind. I think we perhaps this morning, with President Trump's not clarification, but essentially, his outreach to China and saying, well, all will be fine and, they don't want it, we don't want it. Perhaps implication being that something will be worked out. Perhaps start off on a slightly better note. Had this post not come this morning, I think perhaps the reaction would have been a little more sharp. So I'll just tie in the levels here. We've had a nice move on last Friday, the last trading session. The Nifty took out the earlier high of 25,220, which was the high which was made last week, the weekly high. The next stop, the next resistance in that sense is 25,652. So not in a hurry, some distance between where we left off and, of course, where this level is at. Support remains the same, 25,008. The Bank Nifty, it closed above the previous high, like the Nifty, of 56,502. The next stop is 58,163. Again, not nearby, but we've had a nice, decent run. And if the markets got to break out of this range, the extension levels are higher for both the Nifty and the Nifty Bank, and the support at about 55,821. That's the levels as far as the Nifty and the Nifty Bank go. GIFT Nifty is, I think, indicating about a 100-odd point lower start, and we'll pick up from there. But as I said, with President Trump's post this morning, I think markets will be hoping that this means de-escalation and not further escalation. But how's the F&O positioning looking like? Nigel's walked across to the wall with exactly that. Nigel, over to you.
Well, year to date or even in the past 1 year or so, India has underperformed. I think now the time has come probably that we could outperform from here on. And the reason I say that is that a few factors are moving in our favor with regard to liquidity, with regard to flows, and with regard to the other data points as well. So Brent crude prices moving down is good. Dollar index has cooled off a little bit, and the 10-year yields as well has cooled off. So the troika is well behaved, so to call it. But the bigger positive is with regard to what's going on the flows. The FIs, remember, they were net selling 2,500, 3,000 crores. That came down to a net sell number of around 1,500 crores. Then they were selling closer to 500 crores. And now that's done a U-turn. And now we have positive FI flows. And mind you, this is the fourth straight day that we have positive FI flows. So you like that because remember, they have been underweight on the Indian markets and they have been selling all through the year itself. So the FI is turning a corner. We'll keep an eye out on that, whether or not that can hold, and it has more ground to go. The short positioning, that's something that we have been highlighting. And just in the last week, take a look at the shorts that have got covered. From close to around 2 lakh contracts, we're close to around 1.8 lakh contracts, which would effectively mean close to around 8% of their short positions have got covered out. But even after this sort of short covering, still they're aggressively net short, right? They have 1.8 lakh contracts on the short side. In percentage terms, that's close to around 92% of their positions are still on the short side. So the FI is buying in the cash market and in fact covering their shorts. That spells some good times and gives you some kind of cushion. Even on stock futures, if you look at it, earlier they were selling in cash and they were long on stock futures. Now it seems they seem to be reversing that arbitrage because now they're buying in cash and there is some kind of covering that we are seeing in, in stock futures itself. So the bit of a short covering bounce did play out there. The FI as well on index options as well. As we've been seeing the last few trading sessions, they've started writing more puts than calls. And because of that, the PCR that had come down to around 0.85 middle of last week, that's moved back up to around 1.3. Because the put writers, they feel they're back in the game. Whether you're looking at the 25,200 put, 25,250 put, 25,300 put, all of them were fairly active. Now, if you want to look at a tighter range, last week's low becomes important, which is close to around 25,000 odd. So that's the reference point you have on the downside. You'll want the Nifty to make a higher high. And the high that it made in Friday's trading session was 25,330 approximately. But if you're looking at a range, then the recent high at around 25,450, that becomes a level of resistance. So they're going to be important which side of the band we can break. Moving to stocks that I'm looking at, well, a couple of them will be in focus in today's trade. Saman Capital, that's back in the F&O band. The stock has been a bit of a range. Keep an eye out on that one. The other stock we look at is Tata Motors because tomorrow is the record date, which effectively means today all the future contracts will expire today. So they're having an expiry for Tata Motors in the futures market. And if you want to play that demerger, well, today's the last day to buy it. And finally, since crude oil prices have cooled up, I'll keep an eye out on OMCs as well, whether or not there is some interest on these names. So those are the bunch of stocks that I'm looking at.
Thank you very much for that. We should pull up Asia once again. So despite the conciliatory tone coming in from Donald Trump, Asia started off the week on a shaky footing. Hang Seng is down 2.2%. The Taiwanese markets 2% now down on Hang Seng. Taiwanese markets 1.6%. Shanghai has opened with a cut of more than 1%. The Dow futures, though, is still up nearly 400 points, but this follows a decline of 900 points almost in Friday's trades. So it's rebounding, the Dow futures, but not to the extent of the fall that we had on Friday. Let's get in. William Lee, Chief Economist and Executive Director at the Milken Institute now. He joins in. Thank you very much for joining in. You know, if you look at the chronology of events over the last 3 days, the first offensive, perhaps you could say, was from China, restricting the rare earth, then the retaliatory measure from Donald Trump imposing the tariff, and then again a softer tone. What do you think China's response is going to be? Will it signal escalation or de-escalation? And will the markets take the events of the last 48, 72 hours in its stride?
I think Prashant was really accurate when he said that there was complacency in the market, but he was wrong to say it was tariff complacency. I think it was China complacency. The markets have been buying into these little minor victories that have been achieved in Madrid and London, where a deal about TikTok was considered a major victory, when the real game was supposed to be about rare earth supply and sustaining that, having China open up its markets, allowing China to be really part of the negotiations, serious negotiations, as to where the future technology, future AI is going to be. Those are the serious negotiations that we were so-called given frameworks for, but no agreements. And I think the markets had taken those very, very complacently. And I think now the market is waking up and saying, hey, there is no agreement with China outside of maybe TikTok. And even there, the U.S. has agreed to allow its citizens to be addicted to a Chinese algorithm. So there again, I'm somewhat dismayed by how the Trump negotiators, Secretary Bessent and company, are taking these really small victories, or what they call victories, and letting go the big picture.
William, just one thing though, right? The restrictions from China, morning, but you know they're not aimed at the U.S. in that sense. They're aimed at the U.S., but basically it hits everyone else as well. So for example, the restriction on exports of equipment needed to manufacture batteries for electric cars. You know, as I understand it, it's actually pretty damaging for companies here in India as well. They're saying, well, we will license one off, but no one really expects those licenses to come or be approved. Your thoughts, William?
Precisely. I think China is trying to maintain its monopoly control over those new technologies that it worked so hard in the last 10 years to achieve a leading position in. This was all about Made in China 2025. These were exactly the strategies put in place 10 years ago by President Xi to say, we want to control the standard setting, the license giving of these new technologies. And that's exactly what's being done. And they're demonstrating they're serious about that. And that's why I said the negotiations should have really addressed that head on. Jensen Huang was pleading with everyone, saying we've got to allow U.S. companies or somehow get U.S. companies present in the marketplace for selling AI technology. If we don't, China truly will carry out its Made in China 2025 policy and dominate the world, including in India.
All right. Hi, William. That's what I want to come back to India then. Where does this place India? You know, going that, Trump is going after China a little bit more now. Those markets have had a good run. For the Indian markets, we have been underperformers. Do you think there is a case that from here on, we could see some kind of an outperformance? The flows seem to be turning the corner with regard to the FIs. Domestic liquidity is good. And we've done quite a bit on ground with regard to the fiscal policy as well as on the monetary front. Your take?
India clearly has to get its own house in order. It has to put in place the infrastructure that's needed to advance the economy, especially in the high-tech areas. The supply chains have to be set in a way that's durable, but part of that requires the supply of materials that come directly from China. And there, I think President Modi is going to have a very tough game to play, which is to say he's got to cozy up to China and say, we're really your friends, and he's doing the same thing to Russia, and at the same time not alienate U.S. and more importantly U.S. investors that are so interested in investing in India. So India is in that middle position where it needs to secure its supply to ensure that it has a significant position in the production of new technologies, which require a lot of China inputs, but it also requires a lot of American and Western inputs as well. And that's the balancing game that I think is going to be the future for India and how it's going to be able to negotiate those tough currents.
William, any particular, any asset classes or commodities or anything in particular which you think see an outsized move from here? We've had many outsized moves. Gold, silver, Bitcoin, oils, of course, lately moved a little bit. What's your sense?
I've been a big champion of the new technologies, especially AI and its productivity enhancing properties. I think that's what's a part of the American exceptionalism story. And the U.S. economy in the future is highly dependent upon getting productivity gains in place from these technologies. But I think what we've seen so far in the reaction of the markets is that perhaps all this bubble talk might have some substance, because people are worried that the pricing of the AI technologies has gotten ahead of itself, because we haven't really seen the applications that are productivity enhancing. We see a lot of infrastructure being put in place, necessarily so, but we saw that game before with the internet, where cables were laid and not all of it was used until much lower prices occurred. So I think the real issue now is if we may see a significant move, but on the downside, because investors might pull back, given the catalyst that this China rare earth supply is giving it, to say, hey, we might as well take our profits and cut back on some of these multiples until we see some real improvements in the applications. And by the way, all the applications that we've seen so far, at least many of them, are coming right out of China. So that's why Jensen Huang's words of warning about we cannot abandon the Chinese marketplace, because the AI innovators, half the world's AI innovators and researchers are located in China. So that's why it's so important for American companies, technology selling companies, to be present in that Chinese market.
Thank you very much, William, for joining in. The high valuations in AI and tech perhaps had made the markets vulnerable for a pullback, and the tariff threat became the trigger. Thank you very much for joining in. Sharp sell-off seen in Wall Street on Friday. Let's tell you quickly what the interactions that we've lined up for you on our show today. So first up, 8:35, we've got Richard Ridoglia of Matrix Global, who will be joining in to discuss the key trends in precious metals. 9 a.m., Jiganshu Gore of Bernstein will talk about the demand trends in the retail space and Avenue Supermart's Q2 earnings. 9:20, Tahir Badshah of Invesco Mutual Fund will be a market master for the day. 9:35, Kunal Dhamesha of Macquarie Capital and Neeraj Sharma of OneSource Specialty Pharma will join in to discuss the opportunities for Indian pharma as the US Senate approves the Biosecure Act. And following that, Dharmesh Shah of JM Financial Institutional Securities will be chatting with us at 9:45 to talk about his expectations from the cement sector ahead of Q2 earnings. And in our special segment, It's the Economy, Lata will chat with Rikin Shah of IIFL Capital on the banking sector outlook, post the RBI deregulation and expectations from the Q2 earnings.
Well, time to slip into a quick break. We've got a lot of stock-specific action to track for you on the other side. For the time being, I'll run you through the top 10 list. Phoenix Mills, Mahindra Lifespace, Travel Food Services, Scams, Welspun Enterprises, all of them will be reacting to positive news flow. Out of the list, Adani Energy. On the flip side, Avenue Supermarts, Axis Bank, Signature Global, and BLS International will be reacting to negative news flow. Take that break, come back. We get into further detail on all of these names.
Welcome back. Our research team is now standing by with CNBC-TV18's list of top stocks for the day. And first up, markets will react to Avenue Supermart's earnings. Manglam, we already had the Q1 pre-quarter update. How did it fare versus that, and what's your own read?
Well, it was in line with the Q1 update, but importantly, the EBITDA was slightly softer than street expectations. So these numbers, while largely in line with muted expectations, will go down as a bit of a miss, largely because, the revenues which grew by around 15.5%, offered not much in terms of same-store sales growth. The EBITDA actually grew by just 11%. There was a margin compression of about 30 basis points. And at the same time, the net profit, which was further impacted by higher depreciation and finance costs, grew just by 2.3%. The reason why the margins were lower was because the mix of foods in their overall sales increased from 56.5% to around 57%, and that's a lower margin business, whereas the non-foods and general merchandise business actually decreased in their overall contribution. And even if you look at DMart Ready, grew by just around 16% for a category that is growing extremely fast. The state would have liked this to grow a lot faster. The company is consolidating operations out here, and as a result of which, DMart Ready consolidation and expansion will be extremely crucial to track, along with the overall store expansion, whether that picks up or not. And finally, in the third quarter, this quarter as well, we saw some remnants of revenue coming off because of the price cuts in GST. We'll see a large part of that in the third quarter playing out as well. So that's something the street will be watching. I would go with a mild red on this because a large part of the reaction has already happened in the first quarter update. But now, after the results, there would be a mild red on DMart.
Okay, all right, Mangalam, thanks a lot for that. Well, let's hop across to Gaurav. He's tracking Axis Bank. Morning, Gaurav.
Well, good morning. A little sentimentally negative news for Axis Bank because now RBI's high level committee, they have issued letter of caution for the bank. They are also guiding the bank to ensure the strict compliance with the RBI's KYC norms. Now, upon this, bank has said that they have already initiated the corrective measures, and at the same time, they do not see any kind of material impact on financials, operations, or other activities. But let's not forget that there are a few other things also to focus on Axis Bank. First is that the results are likely to come on 15th, and at the same time, when we have seen the growth rate, credit growth has been in a single digit for the last 3 consecutive quarters. In fact, even if we look at the price to book now, the valuation that also trades below the 3-year and a 5-year average, and that is something which is already being factored in. But at the same time, with this letter of caution from RBI, let's see how the impact is going to be on the stock price. Currently, we do not expect any kind of a major setback because there won't be any financial impact, material financial impact, but let's see how the stock reacts today.
Absolutely. Thanks very much for that, Gaurav. Sonal is here with more stocks with news flow. Sonal, good morning.
Good morning, Prashant. Some quarter 2 updates that have come by. Phoenix Mills, they saw consumption growth of 12% in the quarter gone by in their malls business. As far as the commercial office is concerned, they saw occupancy at around 76% in their 2 commercial assets, which compares with around 67% in March 2025. For their hospitality business, the occupancy was flat in St. Regis and their average room rate grew just 2%. They say quarter 1 did see some benefits which did not come by in quarter 2, but all eyes on quarter 3 because that's the consumption season and also GST cuts. So Phoenix will be in focus. For Signature Global, it was a weak set on a YY basis in terms of their business update. Pre-sales were down 28%, volumes were down 17%, but their collections went up by 2% on a YY basis. For Mahindra Lifespace, 2 updates that came by. One is that they have bought a land in Pune, 13.46 acres, and it is expected to yield a development potential of 3,500 crore rupees for the company. The second one is they have again won rights for a redevelopment project in Mumbai. This is in Malad, and they will be seeing a development potential of around 800 crore rupees here. So some real estate stocks will be in focus today.
Thank you very much for that. Let's get to Vinny now for some more stocks which are in the news.
Hi, good morning. So firstly, keeping an eye out on BLS International. Now, the Ministry of External Affairs has temporarily restricted the company from participating in Indian mission tenders for a period of 2 years. Now, Indian mission tenders contributes around 12% of the consolidated revenue of the company and 8% in terms of the EBITDA of the company. So there is some bit of that impact maybe we could see coming in the future. But the company has given a clarification saying that the current contracts which are there in this Indian mission tenders, that continues to be there. So they're not expecting much of a financial impact going forward. Obviously, in terms of just getting new orders, I think that just becomes a concern for the company. So keep an eye out on that. No impact on financials is what the company is highlighting. Travel food services, that is the one we'll keep an eye out on as well. We're expecting green here. The company's subsidiary has entered into a license agreement with Delhi International Airport. This is a license agreement for 3 years, and they will be operating around 14 food and beverages outlets over there. So keep an eye out on that. And lastly, CAMS, that's the one we should focus on, as the board has approved a subdivision of its existing shares into one share for into 5 equity shares is the split that is coming in there. So keep an eye out on that one. Green expected here as well.
Okay, all right. Thanks a lot for that, Vinny. Well, going across to Vivek, he's here to tell us about Welspun Enterprises and Adani Energy. Morning, Vivek.
Well, good morning. Welspun Enterprises will be in focus. The company says that there's a board meeting scheduled on October 15 to consider a fundraise. The fundraise could be via the issue of convertible equity shares, convertible equity warrants rather, and this will be done via preferential issue route. Along with that, the company says that post Q1, they have been declared as lowest bidders in two important projects. The first project is in Maharashtra, where the company is looking or is the lowest bidder for a construction of a 6-lane highway corridor. The total project cost is in excess of 7,300 crore, with the construction period expected at 4 years. Along with that, the company will also, a company along with its JV Malaysian partner, is the L1 in the construction of a new 910 million litres per day water treatment plant in Maharashtra. It's both a building EPC contract as well as an O&M contract for 15 years. The JV bid value, including GST, is little over 3,100 crore. So totally, the company has received orders worth over 10,000 crore in Q2. Now, along with that, keep an eye out for Adani Energy as well. The company has given a Q2 operational update. The company's transmission business added close to 190 kilometers of transmission lines. System availability healthy at 99.6%. Distribution business loss contracted to 4.36%. Collection efficiency in excess of 100%. And lastly, smart metering business. The revenue potential now stands at in excess of 2,300 crore, and the total order book now stands at 2.46 crore meters.
All right, Vivek, thanks very much. And Adani Energy Solutions, Welspun Enterprises are stocks in focus. Well, just a quick recap of things as far as the top 10 stocks are concerned. So stocks with positive news flow: Phoenix Mills, Mahindra Lifespace, Travel Food Services, CAMS, Welspun Enterprises, and Adani Energy. Stocks were on the negative side: Avenue Supermarts, Axis Bank, Signature Global, and BLS International. So that's the run-through of stocks. Let's get you the quick commodities check as well in terms of what's happening. Oil fell sharply, but I think everything is seeing a little bit of rebound across the board. Manisha is here with exactly that. Manisha, good morning.
Morning, and thank you for that, Prashant. Well, absolutely. How the way the other asset classes are behaving is exactly how we've seen in commodities as well. So after that very, very sharp decline that we saw on Friday and crude prices hitting 5 to 7 month lows for both the crude varieties, there is a 1 to 2% of gain as we're looking at right now. This is after the U.S. President stuck a return towards China, wanting to help China and not hurt it. That seems to be really turning it around. But it's a 1% of gain, and we still are trading below $60 a barrel for the WTI crude. This is because ceasefire between Israel and Hamas in Gaza enters third day in Sunday, fourth day today. So that also is keeping the prices under check. So trading below 60 even at this point in time. What we have seen a smart rebound, though, is in copper prices. Fell 6% on Friday, is trading 4.5% higher in Asian markets right now. So almost getting back all that it lost in the previous week. What also has seen very smart gains has been the precious metal prices. So gold prices trading at $4,050 an ounce, not too far away from its all-time highs. Silver is also trading above $50 an ounce, not too far away from its all-time highs. Gold and silver trading firm as the dollar has declined, and as the U.S. government shutdown enters a third week, we are looking at strong support continuing into this one.
Thank you very much for that. Let's get back to stock-specific action then, and for some brokerage calls for this morning. Sudarshan now joins in.
So first one is KFin Technologies. Citi has come out with a note. It has upgraded the stock to buy, and target is raised to rupees 1,215 per share. It says company is well positioned to benefit from robust mutual fund flows and also rise in international clients. Also, it will be aided by Ascent's global capabilities and near-term growth that we are seeing in primary markets. Unlike CAMS, KFin benefits from first, lower pressure of telescoping pricing, and second, higher share of smaller clientele. Company continues to augment its product capabilities, and that is driving revenue diversification, but overhang of promoter stake sale persists for KFin Technologies. Second was AU Small Finance Bank. Jefferies has come out with a note. It has initiated coverage with a buy call, and target is rupees 910 per share. It says it's at an interesting juncture, and transition to universal bank can first lower funding costs, Second, lift fees. And third, strengthen brand to aid growth. And profitability can improve from December 2025 with fall in deposit rates and credit costs. And over FY 25-28, Jefferies expects strong deposit growth, and that is going to aid credit growth to 22% CAGR, and expects ROA to rise to 1.7% by FY 27. Also, growth and profitability that Jefferies believes will aid valuation premium for AU Small Finance Bank.
All right, so thank you very much for that. So those are some brokerage calls as well, and more coming up a little later. We'll take a quick commercial break here. We'll talk about commodities, oil, copper, gold, silver. Richard Redoglia of Matrix Global will be with us to discuss key trends in exactly that. And of course, a special focus on oil, which Richard specializes in. Stay tuned, coming up.
Welcome back. You're tuned in to Bazaar Morning Call. Well, as promised, let's focus on the commodity market. We're now joined by Richard Redoglia, the CEO, Matrix Global, who joins us on the show. Hi, Richard. Always good to have you on the show. Thanks a lot for joining in. Well, the big story overnight is crude oil prices. They have slipped and moved to the lower end of the band. What's your reading of the situation currently? And do you expect crude oil prices to stabilize at these levels? Or do you think there is more downside in store?
Good morning. Thank you for having me. I think, as we've been talking about, I think I was on your show over the last 4 or 5 months. My sense is that the prices do exactly what they're doing. They're trending lower. The bounce we're seeing today, I think, is just that. It's a bounce. The market has found, I believe, we have too much crude in the world, and the supply-demand balance is in favor of the barrels or prices moving lower. So I tend to think that we're going to see this market down to around $55. It's been an area I've been looking for the last number of months. I think, as mentioned on your show a number of months ago during the first Iran crisis, that what that caused was a covering of all the shorts that were in the marketplace. Those shorts over time are starting to come back into place, and that's what we're seeing right now. The market is under pressure. The world is finding itself with too many barrels in place. There has been movement on the U.S. side as far as the threatening of tariffs. And I think there's something important to realize here. When you look at this threat by Trump as it relates to India, and I agree with India about their desire to buy cheap Russian oil. The question really becomes is, what is the effect on the U.S.? And really what we're starting to see is the tariff threat is having less effect on U.S. prices. For if you increase tariffs in India, but particularly on China, what you find is there's going to be a slight price increase. But at the same time, if you see a 15 to 20% decrease in the price of crude oil, you see that offset. And so from a consumer perspective here in the U.S., when I go immediately to fill up my gas tank, I see a significant decrease in the cost of my oil. When will I see the increase in tariffs or the price on goods that I buy from different countries? And those costs are spread out over time. So I think what we're seeing is Trump is playing a proper game. He's doing exactly what he said he was going to do. He is using the tariff regime to direct economic policy, which is the first time in my life, which I think anybody's life has seen this type of approach. And his Secretary of Treasury, Bissett, is right on board with this strategy.
Richard, it may be a bit far-fetched, but if it plays out, Brent crude prices or crude heads down to levels of $55 per barrel, then perhaps would it make sense that, India reduces the purchases of Russian crude oil prices because now crude on the whole is so much cheaper? And that could help strike that deal between India and US?
That's yes and no. Again, we get down to the particulars of crude oil, because what is happening is Russian oil is being sold at a discount to Brent. So even most likely the Russian oil right now that India is buying is probably $55. So where it might be 61, 62, here I see 63, 67. I imagine Russian priced into India right now is probably around $57. Probably could even be a little bit less. And so remember, oil as it's priced is a function of a fungible market. And so the benefit of always buying cheaper oil, no matter what price it is always going to be a benefit. And because India is such an advanced refiner and is selling products outside of its own market, being able to buy Russian oil even at $55, if that's where Brent is trading, they'll be buying Russian oil at $50. That gives them a competitive advantage against other exporters or consumers who are looking to buy oil, or in this case, products, right? Because crude is not really crude; it's just refined products. And so, not necessarily it would be the answer to your question, if that made sense to you.
Well, it did. Thank you very much for coming in this morning and chatting with us. Let's move on and invite Dharmesh Kant, Head of Research at Chola Securities. He joins us on the show. Dharmesh, the stock to watch will be Avenue Supermarts. On the top line, it's come largely in line with the pre-quarter update, but there is a decline in the operating margins by 30 basis points. Will that be a dampener?
Yeah, good morning, Rima. Definitely, yes. I mean, the numbers are very muted, and if I may say so, it's a dismal set of numbers by Avenue Supermarts. And this is a trend for the last 2 years. The numbers have been consistently declining from 25-30% kind of a growth to 15-10, and now 6-7. And this quarter they have posted around 3.8% kind of a PAT growth, which will not augur well with the kind of valuation they are setting on. And 5 cities they have closed down stores. I mean, Amritsar, Chandigarh, Ghaziabad, and all the stores have been closing down, and they are not finding traction in the non-food business. So that's a big worry. This is the place where others have been finding pretty traction, and the attractive valuations are given to those kind of companies. So I think further stock price correction is likely on the cards, and maybe 10-15% from here on. In next one quarter, the stock price should correct. And then they have to do something out of the box to pull out of this, declining trend of growth, depleting operating margins, and I don't know how they are going to fix this up. But it's a sell from our end.
Okay. All right. Hi, Dharmesh. Good morning and good to see you, Ben. We've got initial numbers coming in from the tech space, TCS, yeah, Tata Elxsi as well that came out with the set of numbers today. We have HCL Tech as well. How are you all approaching tech, and what do you like from the pack?
Yeah, good morning, Nigel. I mean, TCS numbers were like just run of the mill. Nothing new on that count. Tata Elxsi was a disappointment, definitely. The narrative has now changed from, normal, BFSI or other verticals of the software products which they were providing to AI-enabled products. So AI narrative is definitely in place. How much this catch up and how soon the catch up can happen and how it translates to better deal wins with a longer time horizon is yet to be seen. I think HCL Tech will also be more or less around the estimates of the numbers they are likely to report today. But I think it's more to do with a bottoms-up approach, and there we have come out with an initiating coverage on Orion Pro Solutions Limited. The company has seen a remarkable turnaround since 2022, post the change in the management at the top level. And this is one company which has consistently delivered 30% kind of a revenue and profitability growth with stable margins of 20 to 22%. And we had interacted with the management. They sounded very, positive on the run rate of 30% kind of a growth being maintained for next 2-3 years. And thereafter, they are more aggressive about the run rate on the growth types. So banking and transaction, which is 53% of the revenue, has been doing well. They have won an order from SBI, which opens the door for other, private and non-private banks and other NBFCs in place. Because once you get an order from SBI, it's easier to get your iCash Pro, that is the cash management product, to be enrolled to other banking system. They have also bought REII, which is again artificial intelligence enabled. And what REII has done, it has enabled all their products with AI inbuilt. So that's doing good cash benefit for them. Data center is one play which they have been pretty aggressive about, and it's the architecture stack of the data center, where again we see a good traction going forward, and open loop transit mobility. So we are penciling in a profitability of around 300 crores for FY27. And even if you value at 30 times PE multiple, so 1675 is the target price which I have come out with, where the PEG ratio is less than 1.
That's Oren Pro. Dharmesh, morning. Thanks for joining us. So HCL Tech, which reports today, and we'll put out a preview as well, you think should be good? Should be better than expected?
Yeah, good morning, Prashant. I mean, HCL Tech has a habit of surprising us straight. So the guidance is 3 to 5% for this FY26. So one has to see how the guidance pans out, whether they maintain this 3 to 5% or there's some tweaking of 20-25 basis point forward. And the deal means how they are going to report on that 2 counts. Margin, more or less, it will be around 17 to 19% kind of a trajectory. We don't expect that. I am very interested in looking at the body language and the commentary of the management, because that is what can, give reflective. Last 2 years, if you have noticed the body language of all IT companies, though they have said they are cautiously optimistic, but the body language was very weak. Even the TCS management, I found a very muted kind of a body language this time around. So let's see how HCL Tech does it. But structurally, we are not a buyer on large cap IT companies as yet.
If we can put these weekly charts up, right? The IT index last week was up 5%. That is the Nifty IT index. The capital markets index, lesser talked about, and we'll talk about this one with Dharmesh in just a bit after a break. The capital markets index was up 5%. BSE there was up 14%, by the way, for the week. Hospitals were a big buzzing area. The index was up 3%, and the real estate space was up about 2.5% as well. So some of this we will get back with Dharmesh in just a bit. We have to take a break, though. Some technical trading ideas for you as well. Sudarshan and Videsh should be with us in just a bit. Hormoz also joins us with some of the big volume movers from Friday and, of course, the action that we saw. Welcome back. There's 8 minutes to go for the pre-open session. Let's rewind the clock back to Friday and look at some of the big movers that we saw. And the price action, volume, delivery stats, etc. as always. Hormoz is here with exactly that. Hormoz, over to you.
Good morning, Prashant. And there were lots of movers in the broader markets on Friday's session. And you start off with a name like South Indian Bank. And the Bank Nifty, of course, did really well in Friday's trade. Now, South Indian Bank has done well in the last 8 sessions, has gained in 7 of them. The stock was up 10% on Friday, as the biggest single-day gain since January of last year. And more than 11.5 crore shares were traded on Friday in comparison to a 20-day average of just 85 lakh shares. And out of those 11.5 crore shares, 4 crore were marked for delivery in comparison to a 20-day average of around about 50 lakh shares. So delivery-based buying seen in South Indian Bank. The stock is up 20% so far this month, making it the best month that the stock has had in this calendar year. Gokuldas Exports, we mentioned this on closing bell on Friday. The stock raise gaining around about 8%, the biggest single-day gain since May. Volumes were the highest in over 2 months. 22 lakh shares were traded, 20-day average here being 4 lakh. And out of those 22, 8 of them were marked for delivery, a 20-day average here of close to 2 lakh. The stock is closed above its 50-day moving average at 753. The next level on the upside comes up the 100 DMA, which is around 839. Tata Communications was one outperformer on Friday among the Tata Group names, and in the broader markets in general. It was the 6th day of gains for the stock. That 10% gain was the biggest single-day advance since April of 2020. The intraday gains were even higher. The volumes of Friday were the sum total of the last 35 sessions put together. And you saw over 1.5 crore shares that were traded on Tata Communications compared to a 20-day average, which is just 2.5 lakh shares. And out of those 1.5 crore shares, 23.4 lakh shares were marked for delivery. Here too, the 20-day average is only 1.5 lakh. And lastly, Yes Bank, among the outperformers on Friday, has gained in 8 out of the last 9 trading sessions. The stock, 55 lakh shares were traded on Yes Bank, 20-day average of 9.5 lakh, and 19 of those were marked for delivery compared to a 20-day average of 4.5 lakh. The other good bit is the fact that the stock trades above the SMBC deal price, which was around 21.5 rupees a share.
Thank you very much for that. So for Tata Communication, the overall volumes went up by more than 50 times. But delivery as a percentage of the volume on Friday, when the stock surged 10%, was about 16%, whereas the 20-day average of the delivery percentage is in excess of 50%. Lots of action seen in Tatacom. Dharmesh, Tatacom got very excited, 10% up. TCS's data center play could potentially benefit the entire Tata ecosystem, but particularly Tata Communication for the data center to data center connectivity, perhaps monetization of real estate, if TCS decides to set up a data center in the land owned by Tata Communication. I mean, are we reading too much into this?
Yeah, difficult to say that, Rima, but logically it does fit the entire, synergies out there. And I think it's more of a pre-positioning with the Tata Communication, the type of build-up we have seen. So there's a scope headroom of the stock price to may go up even 22,000 or 2,100 is likely on the cards. And they also rolled out their 4G network, so on a pan-India basis. So that is also likely to benefit them on the revenue count. So net, I think it's difficult to, exactly guess what, but logically, all the points which you have highlighted does fit the bill.
Dharmesh, great chatting with you this Monday morning. Thank you very much for joining in. Get into a break on the other side. Pre-opening rates. Brace yourself for some impact. GIFT Nifty is down 100 odd points. Also, we'll talk in detail about Avenue Supermart in the retail space. Jiganshu Gore of Bernstein will join in next. Welcome back. Let's get the GIFT Nifty up for you on your screen. Perhaps there will be a break in the recent uptrend. In 6 out of the last trading sessions, markets were actually moving up, inching higher, except I think Wednesday of last week when we took a bit of a pause. And in the entire last week, the Nifty gained close to about 400 points, an up move of 1.6%. But this morning, there will be a bit of a break and we will head lower. So brace yourself for a downtick. That's the first stick on the Nifty. Not too bad. GIFT Nifty was down 100 points. Nifty now down 30 odd points. But we'll wait for the rates to settle down. Sudarshan Sukhani is now joining in along with him, Mitesh Thakkar. Good morning, gentlemen. Good to see you this Monday morning. Sudarshan, let me start with you. What would the approach be if we do get a gap down?
Yeah, good morning. See, we are likely to get a gap down, and the approach is to hold on to your long positions. Do not add to any positions now, because the markets are a little unsettled. But the trend is still up, and this gap down which we are seeing is likely to be a minor correction. At least that's what the indication is now. But we have to protect our trades, and on a closing basis, if the Nifty is closing below 25,100, exit your long positions. Until that doesn't happen, stay with what you have. Do not add.
Mitesh, would you concur that perhaps what we're seeing right now could be a minor correction and long positions should be held on to 25,100?
Good morning. So, my view was that primarily we'll head towards 25, 350, 400 zones. And that's where some important supply pivots exist. And once we cross that, then I think, we will see some kind of a strong continuation on the upside. Now, we hit 25, 330 and slightly tapered off. I would not even call this gap down as a correction. I would just call it as a minor pullback. My sense is that the directional bias on indicators, averages, the chart setup remains on the positive side. So unless until we start, breaking below the levels of 25,100 zone, I think every decline would be a buying opportunity. My sense is that we might not actually even get there. So I would maintain a very positive view on the index, but yes, I think tactically a close about 25,400 would confirm strong momentum on the upside. So waiting for that, but the bias is definitely on the upside.
Okay, let's get to stocks then. Is it going to be all long positions, buy the dip? Sudarshan, your stock calls?
Almost, but not all. 361 is a buy with a stop under 1050. Axis Bank is a buying opportunity with a stop under 1160. My only intraday short, and that means I do have a short suggestion, is Jindal Steel, which has been suggesting a strong distribution. Look for a short sell intraday with a stop above 1050, and finally a buy in ONGC with a stop under 230. Primarily, the bias is still on the long side.
Yeah, no, absolutely. Bias is on the long side. Mitesh, what about you? Individual trades?
On individual trades, I have a mix of buys and sells. On the buying side are two banking names. Bandhan Bank, which had a very strong price action on Friday. If you get it on a mild pullback, say a point lower, 168 is the area I would recommend to buy the stock. Keep a stop below 165, look for a first target of 175. Similarly, AU Bank is a buy around 760 with a stop at 749 for targets of 785. A couple of stocks which were looking slightly on the negative side on intraday charts where we have some sell signals is Ashok Leyland, which I would recommend selling with a stop at 139 for a mild target of 133, and ICICI General Insurance, ICICI GI, which is sell with a stop at 1880 for a target of 1820.
Thank you very much for that. If you list out the cues, the events to track for the day, one, we've got the India September CPI inflation print. That will come out post-market hours. Then at 10 o'clock, you'll have the Tata Capital listing. It was a mega issue, 15,500 crore. Overall subscription was 1.95 times, but retail was a bit subdued, just 1.1 times. On the earnings front, HCL Tech, Just Dial, Anand Rathi Wealth. And on the Supreme Court side, the Vodafone Idea AGR hearing will be today at the Supreme Court. So Ashmit now joins in. So we'll talk more about the Supreme Court and why Vodafone Idea should be on your radar this morning.
Well, this is clearly a big talking point in the Supreme Court today. Vodafone Idea's application for relief is to be taken up. Mind you, they had begun by asking only for a recomputation of the AGR due. Subsequently, they amended their application and expanded the scope of relief they are seeking. They're now also seeking a waiver of the penalty interest and the penalty interest on penalty component. What is interesting, however, from this round of litigation is that the government is clearly batting from their side. The government made it clear that they are 49% stakeholders, they have skin in the game. The facts on the grounds have changed, and now they want some form of resolution, some solution from the apex court. What that solution looks like, well, we have to wait to hear from the government counsel on what a possible solution may be. We're yet to get more clarity on the way forward. Hopefully, at the hearing, the Supreme Court will begin to give a better picture of what the road ahead for Vodafone Idea looks like.
That's today. Well, do we know the time, Ashwin, this comes up?
Well, the hearing is scheduled in the first half. We can expect it roughly around 11:30. That's when I believe the case is likely to come up. But like in all things court-related, it is unpredictable. It is subject to a whole lot of factors such as availability of lawyers, when the case gets taken up. So various factors, but roughly expect around 11:30.
Got that. I mean, a lakh odd crores on market cap for Vodafone Idea, and government's government's got about 50,000 odd crores in terms of that market cap to in a way defend, right? And as Ashmit said, the stance seems to have changed, and the government keen intent on finding some sort of a resolution. Stocks on your screen in the pre-open session. Mangalam is here with just a look again at Avenue Supermarts and what's the bull case, what's the bear case. Mangalam, tell us.
Well, it's a stock which has always had divergent opinions, right? Some speak about the strength of the franchise, some speak against the valuation. So HSBC, for instance, has a reduced rating and they have a target price of 3,700 rupees. They're saying that even as gross margin decline stabilized this time around, the operating expenses actually elevated, which was contrary to the analysts made, and as a result of which EBITDA margins were lower and moderation in the like-for-like growth as well, along with the DMart Ready reducing their exposure to 5 cities, makes them reduce their view on the stock with a PE multiple of 60x because they believe that key concern remains moderation in like-for-like growth given competition. CLSA, on the other hand, despite these numbers, has a high conviction outperform rating with a target price of 6,300, which is among the highest target prices that we have in the stock. because they're saying that, it was whether private label price deflation and lower sales density for new stores that led to a bit of a miss. But the company is on a growth path, and that's reflected in the employee cost growing 33%. And also, we saw, the expansion. Finance costs were higher because the company had taken a bridge loan to fund network expansion. And this, they believe, will be the next delta or growth trigger for DMart, which has accelerated store expansion. CapEx as well has been higher, 10% higher than what the company did same time last year, which was also a high base. So they're saying that the company is on a transition period right now. And the second half will see higher store rollouts.
All right, Mangalam, thanks a lot for that. Well, to discuss this and more, we're now joined by Jignanshu Gaur, who joins us on the show. Hi, Jignanshu. Good morning. Good to see you, Ben. I believe you're leaning towards the bullish side. Tell us the rationale. You believe that the company is in a transformational period right now. Tell us more.
Thank you. Thank you so much. It's always a pleasure to be here. I am on the bull side of the case, as we saw Mangalam say that the result had everything for everyone. My rationale is it is a transformational phase where they need to fight off the competition from quick commerce, which at 6.8% LFL is a decent job of their core business holding up well. Second, they've realized that F22, 23, 24 network growth was under what they should have done. And hence their whole investment into employees, into new stores, is the transition phase that they are going through. If we see just on store growth, they have spent 3.5, almost 4,000 crores in the last 3 years. And the capex for H1 itself, again, was another 1,500, 1,600 crores. That bodes well for accelerated network expansion. I think the competition pressure will ease out as we move towards the next few quarters, and so will the cost pressure. Because and that's the reason for the bullishness for us.
Jignanshu, so according to you, what is the valuation now? Avenue Supermart is trading at 70, 75 forward. What's the number?
Yes, it's around 70, 75 forward. I think there is a difference in how people value it because there is almost a 10% delta on standalone versus consolidated. So the way I like to think of the valuation is you do it on standalone and then think of what valuation you want to give for DMart Ready business.
So how do you justify a valuation of 70, 75 times? Because growth has been moderating. And plus, investors also have an option to play, say, an Eternal or Swiggy, where the growth rates are a lot higher.
Yes, so I think it's a choice that investors have of playing a business model which is solid, which has potential for growth, but... Hello?
Yes, we can hear you. Go ahead, Jignanshu.
Sorry. It's a solid business model which has potential for growth, and it's about replication, where the margin profile is at the bottom, versus a business where a lot of the expectations in the pricing are already built in. How do I justify valuations? Is imagining a scenario even in 2030, do we expect the entire modern trade business to go out and everything be replaced by e-commerce, or do we feel that there is a space for modern trade as well? So I feel it's coexistence rather than a question of existence. So I think the growth, when the margin profile comes back and the operating leverage comes back, the PAT growth will exceed expectations, which is where our delta versus consensus numbers also exists. It's not on growth, not on valuations, it's on margins.
Okay, all right, Jignanshu, we appreciate you joining in and giving us your take on the sector. We look forward to having a longer chat with you, but we've taken your point on board that for Avenue Supermarts particularly, it's in a transformational phase and you continue to remain bullish on the stock.
You said margins will also, I think, have bottomed out.
Yes. All right, well, let's get in Sudarshan back on the show for his 9-10 call. Sudarshan?
Yeah, it's Axis Bank. Buy Axis Bank with a stop under 1160.
Okay, got that. Axis Bank is a stock that we're looking at. A bit of a negative news flow that came in, mild negative, but Sudarshan is sounding a little optimistic on the prospects there. Mitesh as well is with us. Mitesh, tell us, what is your 9-10 call?
I'll go with the buy on Bandhan Bank for targets of 175 and a stop below 165.
Okay, all right. Mitesh, I wanted your view since you're giving us Bandhan Bank. What about the Nifty Bank? That's got into a very, very good rhythm, right, in the last few trading sessions. And there were a lot of shorts in the system as well out there. So the levels on the Nifty Bank, just to revise?
So I think my belief is that this rally has, a chance of hitting the highest ever weekly closing of 57,440, maybe even surpassing it. But in the short term, with the Bank Nifty rallying from 54,350 to about 56,500, if there's a pullback, it could see the Bank Nifty test 56,000, but that would be a very, very good entry point for me.
By the way, the stock we could watch today is BLS International, because as Vinny was earlier pointing out, the company has been debarred by India's Ministry of External Affairs from participating in any future tenders or contracts related to Indian missions abroad for a period of 2 years. And this is effective immediately. And, it looks like it's going to be a slam dunk, 17% gone down. And lower for BLS International. And MEA's decision stems from unspecified complaints and legal proceedings involving visa applicants. The exact nature of the complaints has not been publicly disclosed. Existing contracts are unaffected. Remember that existing contracts are not affected, but the company cannot participate in future tenders related to Indian missions abroad for a period of 2 years. So that is quite a bit of a hit to the company's future growth potential, and the stock is taking a bit of a knock. But it's about 0.5% down now, Prashant, the Nifty and the sensex in pre-open.
So not so bad, right?
100 points, right? 100 points.
So par for the course in that sense. Markets, of course, have come up very, very nicely to almost 25,300 kind of levels as of Friday's close. And we're giving back a little bit this morning. So we'll pick up from where, we kind of sort of left off, slightly lower, and then we'll start to spot individual stocks, etc. as well. BLS is one, and there are a bunch of others as well, which we want to highlight. Here's a quick recap of what we've put out in terms of news-related stocks, etc. from the morning. Avenue Supermarts will come up 1% lower. Phoenix Mills, the Signature Global, which is down about 0.5% as well. Wellspun Enterprises, it's positive news in terms of orders. Adani Energy Solutions, Axis Bank is the other one. And of course, we highlighted BLS. CAMS, of course, is also about 1/3% higher. News-related, not very much at all. And we'll see if, the other two areas do any better, which is IT and capital market names, right? 25,190 is where the Nifty is at. 25,200. So it's just a 0.25% cut. The Nifty Bank is down 0.17, so nothing at all. This is, routine kind of start to begin the session. Small cap index is up 0.75%, or is it? No, it's down 0.4%. It's just opened up. And the mid cap index will also come up. Is down about 1/3%. So it's, absolutely fine in terms of what the start looks like. Let's just look at what the Nifty heat map is looking like. How many stocks up and down, and then we'll move on from there. So just 10 names higher, and the rest of the 40-odd names are lower. Trent is on one end, and Indigo is at the other end. Indigo is looking up. So 25,200 on the Nifty, which is, by the way, no longer last week's high, but the high which was taken out on Friday's session. So we are back there once again, guys.
Well, that's right. From the broader markets, you have BLS International, the stock that Rima just spoke about. That's the one that's taken a pounding. It's down close to around 15% now. So clearly the news flow negative, and the street is reacting out there. GK Energy, that's a newly listed company, came out with a set of numbers. On a low base, actually, the numbers look good. But that stock as well is getting sold into. So just keep an eye out on that particular name. What else? In terms of the Nifty, we're down close to around 100 points. But one would say it's par for the course because, the GIFT Nifty was suggesting a 100-point downtick as well. The Nifty Bank is doing a relative outperformance here again. Another stock from the broader markets, I think, that came out with a set of numbers is Affordable Robotic. That's up close to around 7%. Volume's not high at all, though. Only 35,000 shares traded so far. Dream Folks, after coming down by close to around a fourth from the peak, that's popped up in trade. That's up close to around 7%, moving on decent volumes as well. So that's another stock that you should keep an eye out on. Rima?
Okay, in the frontline pack, it's IT, which is a bit on the back foot. Remember, the Nifty IT index was up close to about 5% last week. It retraced, or it was flattish on Friday, and today it's down nearly 1%. Infosys, HCL Tech, Wipro under pressure. These three heavyweights are seeing a cut of more than 1%. HCL Tech reports the numbers later today. It comes out usually around 6 o'clock. That's when the press conference is scheduled. And HCL Tech is likely to report a growth this time, 1.5% on a quarter-on-quarter basis. And the company had also said that last quarter, 2 of their large deals got deferred to Q2. So if that closes, then deal wins should improve for HCL Tech on a sequential basis. But they had also spoken about a restructuring, both on the employee and non-employee front. So we'll wait for details on that. So HCL Tech, basically IT, is a bit on the back foot. Trent was one of the biggest losers last week. Trent had reported, Trent's stock had declined nearly 4% last week. And when they came out with that, quarterly update, it was about a 17% growth in their standalone revenues, which is lower than what the analysts were penciling in. I think the company's own long-term guidance was about 25% growth. So Trent has taken a bit of it continues with its downtake. ONGC, BEL, ONGC in focus, crude prices too. So ONGC is now your top nifty loser. The stock is perched at the 200-day moving average. So ONGC down 1.7, BEL down 1.25. Tata Motors, Adani Enterprises losing nearly 1%. IT is a bit shaky, seeing profit booking. Axis Bank, we spoke about it with Gaurav, and that's open in the red. On the way up, it's the auto names, Eicher Motors, Bajaj Autos. So the two-wheelers are in top gear. Apollo Hospitals, Asian Paints, Bharati Airtel are up close to about 0.5%. The bias is on the way down. The Nifty is lower by 83 points at 25,200.
So BLS, of course, is down 16% as we speak. It's the number one volume-led loser right now. And of course, I think as you guys highlighted, Reliance Power is down 7%. There's regulatory action against the CFO of the company. So look at the volumes there coming down sharply. Tata Communications, we highlighted. Tata, of course, had a big up move on Friday, so just giving back some. Reddington is something similar, big move on Friday, giving back a little bit. And I think for something like a Vari also, it's something similar. GK Energy is another one, down about 2% or so, but we're just sort of starting up, and we'll have to give it some more time. Vari is up 9%. Vari is the biggest volume-led gainer on the NSE. So 1,234 is where Vari is at. MCX had a massive move, I think, on Friday or on Thursday. It moved big, some 5-6%. K Fintech, the double upgrade coming in from Citi, 2.5% higher. Silver ETFs are once again making a move, right? So look at Silver Bs, it's up 3%. If you have these up, there is 2-3 of these. HDFC Silver ETF, that is up about 3%. So no stopping. We had a bit of a pullback on Friday, but they are moving up once again. MAPMA India is up 4%. There is SBI Silver ETF, which is also up about 3% or so. So you got moves coming through on many of these names. Tahir Badshah.
Not just Kotak, I think UTI Mutual Fund and SBI Mutual Fund have temporarily suspended lump sum investments in silver ETFs. So that continues.
Yeah. In silver ETFs? Or
silver ETFs. And I don't know.
ETF fund of funds?
I guess. But that's what Kotak had told us. Yeah,
because Nilesh had told us that by law, you can't restrict flows into ETFs.
Correct.
But fund of funds which invest in turn into ETFs, they've stopped lump sum. So we'll have to just
we'll
check
have to wait
if that is what it is.
Fund of fund.
Fund of funds, yeah, exactly.
It's the fund of fund.
Tahir Badshah is with us, Chief Investment Officer at Invesco Mutual Fund. Tahir, great to have you with us here. Good morning. Appreciate it. We are talking about gold and silver. So let's just let me ask you, you're an equities man out and out, but I don't know if you have any views here. It's just a massive one-way move that we've had. What's your sense, Tahir, from here?
So while I'm an equity guy, but over the last 1 year, we've been running a multi-asset fund, and to that extent, I've started to keep a little bit of a tab on gold and silver as well in the more recent months. And by and large, I think we have been constructive, pretty constructive, I would say, over the last 12 odd months since we've been running that fund very actively. And I think we still continue to like the space, but we have to remember that, a lot of the demand in gold, as we all know, has come because of the large elephant in the room, which is basically the central banks. And I think on last count that I probably happen to see, in terms of the reserves position, gold now starts to probably form nearly about 35% of global reserves, and this has moved up from probably more like 10 odd percent in the last 3 odd years or so. So there's been a massive amount of diversification of reserves of key countries, which has happened over the last some years, and that has driven a lot of the gold interest. So I would like to think that this is something which is kind of, reached a reasonably decent proportion. Of course, you can argue that it'll probably go to 40 odd or 50 odd percent. But beyond a point, gold is an asset which is relatively liquid. And while it has its own attraction today, given the global geopolitical and geoeconomic circumstances, but I would like to think that investors probably who are investing in gold, and even for us, likes of us as well, we are moving with an expectation that probably Canada outperform equities for the near term, maybe Indian equities on the headline index, etc., for about 10, 12, 15 odd percent. That's what probably we are looking forward to from here on, not necessarily the 30, 40 odd percent or 50 odd percent that gold and silver have delivered in the recent past. And between gold and silver, I think our relative preference for silver has been higher in recent times.
So Tahir, in your multi-asset fund, what is the holding of gold and silver, and how much are you comfortable holding? How much can that go up to?
So we are at about 19, nearly 20 odd percent in gold and silver. That's what we've probably been at for a while, but within which we've changed the composition of gold and silver over the last some months. But by and large, the aggregate number on the precious metal side has been in that vicinity.
Would you look to change it from the current 20%, and how has the composition changed internally?
We moved a little more towards silver. I think we are now nearly, we were almost virtually everything in gold about a few months back. We're probably now more like 12-8 between gold and silver in our overall allocation by and large. I mean, as per the latest disclosed fact sheet figures. But yes, we have moved our proportion towards silver relatively quickly in the last some time.
All right. Hi, Tahir. Good to see you in. Good morning. Tahir, but what's the view on the markets? Investors actually have shown quite a lot of maturity, the domestic money at least, because they have been watching, no returns for the last year or so, and yet the flows continue to come in. How are you reading the current market setup? Because ultimately, earnings need to pick up in Q3 and Q4. Do you think that could be the case and markets could actually start looking up from here on?
Well, at a level, I'm reasonably constructive, at least as far as global equities is concerned. I mean, we think US is in a good place, China too is in a good place, primarily driven, of course, by tech, AI, etc. But having said that, I mean, there is still a fair bit of resilience as far as that economy is concerned. There will be certain temporary challenges on account of inflation, but maybe even that too can probably be offset given where oil is, and it's been pretty soft and for the good of all of us, not just the US and China or the other countries. But I think to that extent, therefore, I think, US is quite sorted at this stage from an economic standpoint, and so is probably China. I think from an India standpoint, we have a little bit of struggle for sure. We have already underperformed a fair bit. You mentioned about earnings, and earnings is something which obviously at the end of the day has to materialize, and that is where the rub is. We still are a little languid as far as our earnings momentum is concerned. We probably might get to closer to double digits or early double digits by the March quarter, but this will still be short of market expectations, which are more like somewhere in the 13 to 15% range. So my broader sense is that I think we will probably see the headline indices struggle, but we still are very comfortable. We are still very constructive, at least as far as the broader market in India is concerned, particularly in the mid cap and small cap space. And we continue to probably, ideate. We continue to find opportunities along the way, particularly given some of the recent underperformance in certain parts of the market. So it is still a stock pickers market. I think the best chance for investors to probably generate alpha, get to closer to their target returns, lies through the mid cap and small cap parts of the market.
Have you been finding opportunities in that space lately, or in what areas, what segments, Tahir?
On and off. I mean, we're not necessarily dried up in terms of investment, opportunities. I think at various points in time, certain sectors do provide that opening. Primarily, it might be At sometimes it has been industrials at certain points in time, parts of industrials, defense, and sometimes it has been real estate at, those again, pockets of the market which have underperformed. I think more recently we have been very excited about the consumption space. You would know that we are in the midst of an consumption NFO as well. So that's an area which is quite appealing across various sub-segments of that space as well. Basically, I think to us it looks like policy is essentially an important determinant, and generally follow the policy. I think if you follow the policy, you'll follow the money, and probably that is what has happened in the last 3 years. We've looked at how industrials have performed, PSUs have performed at various points in time. Certain specific thematic funds have performed. I think probably we think that the confluence of policy and various other factors is making the consumption space now relatively more attractive. So that is where we are finding incremental opportunities across the space, whether it be consumption retail, consumption tech, it could be autos, it could be, like as I said, real estate, and healthcare, for example, domestic healthcare, and so on.
Although in the other areas like defense and all of this, right? I mean, those are areas where there was direct, it's like almost it's industrial policy in that sense, right? The government is spending directly, and the companies, the stocks that you buy are essentially recipients of order wins, awards from the government. In consumption, it's a little indirect. We don't know. So it's a bit more, you don't know where that money is going to go, right?
Yeah, but Prashant, if you look at all the policy measures since the start of this calendar year, they've all been consumption positive or consumption pro. Look at it from the point of view of tax cuts in the budget to interest rates cuts to GST now and few other, state-specific measures, plus also the upcoming, 8th Pay Commission, which gets active from probably 12, 18 months from now. All these are going to be pro-consumption. I mean, of course, if we have to check as to what happens over the next some months, particularly after the festive season is over, because that will be the true test of how consumption holds up. But I think we've seen many more factors coming together that increases the probability. We can never be sure. But I think many more things are in place, not just one factor, but a multitude of factors. And that probably makes the whole thing probabilistically lot more stronger.
Tahir, when the entire industrials, defense, the capex theme, that upcycle started a couple of years back, it was under-owned, there wasn't too much conviction, and therefore you got outsized returns in the stocks. Now, suppose if the next leg of the alpha in the market will come in from consumption, many of these stocks are also very expensive to begin with. So if someone buys a consumption fund, for instance, right now, what kind of returns can they expect?
Rima, typically when some of these themes have, found the right confluence of factors, and we have a good starting point probably in terms of valuations, etc. If that mix is all favorable, then generally the first 2-3 years tends to involve a fair degree of re-rating as well, along with recovery in earnings growth. And I think that is where, you probably have maybe significantly higher than average returns. You could probably get past 20%. That's quite possible. We've seen it on several locations in the past on a CAGR basis. And then obviously after which it will trend down to relatively more sedate or probably more like trend growth. But consumption, I think what we've also seen generally over its history is that typically it has been something which has done reasonably well, even without any triggers. I mean, on 7 out of 10 occasions, it has probably beaten the broader market with a decent amount of alpha. So it has its own bit of resilience, but if you are front-ended with a few factors which can probably propel growth significantly, then I think the first 2-3 years could be very rewarding.
Okay, all right. Final question, Tahir, before we let you go. You had briefly mentioned autos, I think, and that's a space that's come to life, particularly in the last 2 months or so. And post this GST rationalization, it appears the market is quite hot on it. How do you approach this theme? What do you like, across categories, whether it's the leaders or ones that are making a dent into some of that leadership?
So I think there are few pockets that we like. We like, for example, two-wheelers, of course, because that's where we will probably see a larger part of the action, within which we probably like we like the EV players within that segment. We, within the four-wheelers, particularly PVs, We are obviously, there it is about following the formula of follow the model launches and the model pipeline. And I think in that maybe there are a couple of companies which at various points in time do turn attractive versus the other. So that's also something that we like. We are probably not too significantly exposed as far as the CV cycle is concerned, I would say. But maybe there could be some attraction out there. And we have some bit of exposure as far as auto components is also concerned. But I think that is by and large the print as far as autos is concerned.
Great chatting with you this Monday morning. Thank you very much for joining in. You have a good day. Getting back to the markets, the Nifty is now below 25,200, 120 points down. It's still about a 0.5% fall, but it slipped a bit. Tata Motors is now your top loser. After that, you've got ONGC, BEL, Adani Enterprises, Tata Steel. These are the top 5 Nifty losers. Let's talk about KFin Tech, double upgrade. Sudarshan now joins in with the details. Sudarshan.
So the stock is currently up almost 3% after Citi has come out with a note upgrading the stock to buy, and target is raised to 1,215 per share, implying an upside of almost 10% from current levels as well. And it says company is well positioned to benefit from robust mutual fund flows and also rising international clients. It will be aided by Ascent's global capabilities and near-term buoyancy that we are expecting in primary markets. Unlike CAMS, KFin benefits from first, lower pressure of telescopic pricing, and second, higher share of smaller clientele, and it also continues to augment its product capabilities that is driving revenue diversification, but overhang of promoter stake sale persists as per Citi.
Right, no, absolutely. Thanks very much, Sud, for that. We just want to put the spotlight on BLS International, which of course is the big casualty. Vinny is here with exactly that. Vinny, morning.
Hi, good morning. So yes, BLS International, that's ranking in trade today after the Ministry of External Affairs has temporarily restricted the company from participating in India mission tenders. This is for a period of 2 years. Now, India mission tenders accounts to around 12% of the consolidated revenues and 8% in terms of EBITDA. The company has given a clarification, and they are saying that the development does not impact the company's current financials or any ongoing operations in this mission that is there, and the orders will not have a significant bearing on the company's financial outlook. But nonetheless, when you look at it, obviously 12% of their revenues coming from these missions, right, the India mission tenders. So because of that, there could be some pressure. If they do not get any new orders on that front for 2 years, we could see some pressure coming in over there.
All right. Thanks very much for that, Vinny. Appreciate it. Well, let's talk about the pharma space. Now, the U.S. Senate has revived the Biosecure Act, a law aimed at cutting ties between American biotech agencies and companies flagged as national security risks. This is expected to create opportunities for Indian pharma and biotech firms in the global supply chains. We have Kunal Dhamesha, pharma and healthcare research analyst at Macquarie Capital, and Neeraj Sharma, CEO and MD at OneSource Specialty Pharma. Gentlemen, great to have both of you here. Thank you very much for joining us. Let me, Neeraj, start with you. Prashant, this side. It's good to be speaking to you after a while, Neeraj, once again. And I want to talk about your specific business as well. But then let's just get this Biosecure Act out of the way. One line of, and I'll start with perhaps the pushback that I've heard from some, that the Biosecure Act was part of this National Defense Authorization Act, which is the NDAA, even last year. And in the last minute, it was kind of sort of knocked out from that act. So the skeptical view is don't celebrate yet. So just wanted your thoughts, how you think about this entire issue.
Yeah, thank you, Prashant. Thank you for having me here. See, while I hear your skepticism on the act itself, I think we should look much beyond the act, right? It's not what the act says what is important. It is the strategic direction towards supply chain diversification. I think that is what we need to look for. And I think what has happened here is that what this act, whether the first version or the version now, what they have done is basically change the conversation in the American pharma boardrooms. Where the boards have given a very clear direction to the companies to really look at diversifying their supply chains and look at alternatives and to reduce concentration, and dependence on one country. And I think that particular point is really irreversible, whether this act, whatever shape or form it takes or doesn't.
Do you think, I mean, the other bit is that this is a much more diluted version as compared to what was proposed last year. Do you agree with that, Neeraj?
I think, Shant, while I understand that the tone may be softer, but I think the central essence remains as it is. And I think as a central essence is very clear, which is towards diversification, towards reducing dependence, towards finding alternatives to having too much concentration in one country. I think that essence remains absolutely intact. There has been no change in that direction.
Got that. Now, can you run us through, Neeraj, if this sort of were to become law, become an act, both House and Senate pass it? What are the implications? I mean, will American companies have to stop working with sort of sourcing from China? Will they have to divert sourcing to other countries like India? Is that a big shift? How large? I mean, any way to think about the numbers here?
Yeah, sure. See, it's very clearly there is a significant upside for Indian CDMOs, including like us in OneSource. Any CDMOs and companies with adequate infrastructure, with the right regulatory strength and the agility to enter into long-term partnerships with global pharma will be beneficiaries, right? Because it's we have been building capabilities and while the time, how much time it takes for the companies to really find alternatives, these are long gestation businesses. It will take some time, but I can tell you, we at OneSource, we have been seeing a significant uptick in RFPs and queries over the last many quarters, and I hear the same from many of our other competitors in this space. So definitely there is an upswing. Definitely there are queries and RFPs coming in. How they will convert into numbers over the next few years remain to be seen. But it's a definite upside is what I tell you, because there are very few alternatives to China here. Of course, South Korea was much earlier in this field, but after that is India, and I think from the base where we are in, we have a very even a small shift towards India will actually end up as a significant driver of growth for Indian CDMOs.
Mr. Sharma, just stay on. We also have Kunal Dhamesha, Pharma and Healthcare Research Analyst at Macquarie Capital, now joining in. Kunal, thank you very much for joining in. Mr. Sharma was just saying that they and the industry, as what he's learned, has seen a significant uptick in the request for proposals, queries. And he's very bullish. But you believe that what has passed by the Senate is a very watered down version, and therefore the benefit may not be to the extent as what perhaps the street was hoping for. I mean, give us your first thoughts.
Sure. So I would not say, it's a watered down version. I think for Senate and House to kind of basically pass the Biosecure Act, they have made some amendments so that, it doesn't face a lot of opposition. So right now they have removed the names of the companies which are kind of classified as a biotechnology companies of concern, with which the businesses cannot be done. And the current version basically links, the biotechnology companies of concern to another list that is published by the US government, which is called 1260H list, wherein US government lists all the Chinese companies which either are Chinese military companies or they have ties with the Chinese military. And so the act will basically put all these companies in that list as a biotechnology companies of concern, rather than actually naming the companies in the act itself. Right now, I believe it's much more forward-looking, because the list of the 1260H list gets updated every year. And given that it is linked to this list, I believe that there is a much more uncertainty for the innovator companies, going forward, because the list can get updated every year. And hence, while earlier only 5 companies were mentioned, now it could be any one of the Chinese CDMO list. So I believe that right now, while it looks like the scope has been diluted, but the scope, in my view, has been broadened, and it can impact any of the Chinese CDMO companies, which makes it very uncertain for the innovator companies to kind of, go ahead and give projects to any of the Chinese CDMO companies. So while diluted but broadened is the way I would put it.
Kunal, this still has to go through the House and gets the president's signature. So in that sense, it's still a wait and watch. And as far as we understand, I think last time it got blocked after the Senate.
It was not blocked. It was supposed to be tabled on the Senate for the votes with the National Defense Authorization Act of 2025. But it was not included in the NDA package of 2025. And hence, it didn't pass as an act. Because see, generally, the older Congress, when they know that the administration is going to change, they generally don't work on this kind of key piece of legislation, because the next US administration would come in and they would have everything kind of given to them. So that's why it was not tabled on. Now, in terms of timeline, when I see, generally the NDA needs to be passed by House before the end of the year, or before the House goes on the year-end break. So we believe that we'll see a lot more news flow coming in from the House of Representatives side on this by the end of this year.
We're running out of time, so I just want to get in one question to both of you. So if you could keep it short. Kunal, one stock, if you had to bet on to play the CDMO opportunity, basis this Biosecure Act, which one would it be?
For me, it would be DB's Labs. I think it's kind of very well positioned.
Okay.
Can't ask Neeraj for the stock. This stock is going to be one short.
But Mr. Sharma, how soon can we get a deal signed? You said you've seen a lot of, requests for proposals and queries. And what could perhaps come in the way?
See, I think it's only a matter of time, because these are long gestation businesses. I think it's the request for proposals will convert. How many? It's difficult to say at this time. I think one thing which companies will have to really focus on is also to build on the IP infrastructure, because what we as in the industry have to give comfort to global pharma is that their data and intellectual property is going to be safe in India. And I think that's the comfort we'll give. And once we do that, and with all our track record, I think we have got a lot going for us.
Got that. Neeraj, if I can ask you for your, on the semaglutide GLP-1 sort of opportunity, you still maintain that that these partnerships on GLP-1 will yield about $400 million in revenues by FY28, which you've stated earlier?
So we have said we'll reiterate our guidance, but just so that we are right now in silent period as far as OneSource numbers are concerned. So I would really not go beyond that. We will have this conversation after our results are out early next month.
No problem. But it's all on track in that sense, right? Because at the margin, sure. I'm not talking about not talking about OneSource per se, but at the margin there was some not concern, but maybe there is a lot of fill finish capacity which is coming up. So maybe by the time a lot of these patents a lot of these drugs go off patent, and then generics start to make it, and many of the top generic companies are your clients, there will be a fair amount of sort of supply in the market. So just a quick comment, if you will.
No, I think I said that earlier. I still maintain that there will be, as the markets get formed, there will still be constrained supply, to begin with, and it's not going to ease out very soon. It will still take a couple of years. And also, these are very complex products. Not everyone who have filed the product is going to get approved. So it's still going to be a restricted play, both from the supply, and the companies who get approved, and the companies which can really supply the market and the actual demand. So I think what we have said is going to stay put at least for the next couple of years.
Neeraj, it's a pleasure. Thank you very much for joining us, and thank you very much for your time. Kunal, really appreciate your time here on CNBC-TV18 as well. We're going to take a quick commercial break here. Be focused on the cement space in just a bit.
Welcome back. Let's talk cement now. This is our special segment, Quarter Se Quarter Tak, and Nigel has moved over to the big wall to give us the expectations from the cement industry in Q2.
Well, that's right. Today we're breaking down the Q2 FY26 earnings preview for the cement sector. A quarter that's marked by strong EBITDA growth despite soft volume trends. Let's dive into the key drivers then. First up, the cement sector is expected to post a strong 50% year-on-year growth in EBITDA. That's going to be supported by around 5 to 6% year-on-year increase in cement prices and benign input costs as well. This comes on the back of a soft base that we saw in Q2 FY25. However, the volume growth remains muted, which is eating partly into the benefits of improved pricing. Industry-wide volume growth is expected to remain under 5% or around 5% on a year-on-year basis, which is continuing the weak trends that have been observed over the last few quarters. This has been impacted by heavy monsoon season, an early festive calendar, and dispatch disruptions in the lead-up to September 22nd, when the GST rates were revised. That said, M&A activity has supported volume growth for some players among the large names. UltraTech and Ambuja Cements, where they're expected to lead with volume growth of around 10 to around 15%, thanks to the recent consolidations that we have seen in both those two names. Among mid-caps, JSW Cement as well as JK Cement, they could post as well 15% and around 10% growth respectively. On the weaker side, Shree Cement, Dalmia, Nuvoco, all of them are expected to see sub 5% volume growth. And Ramco, there's a chance that it could possibly report a flattish to a mildly negative number as well for the past quarter. Sequentially, the industry EBITDA per ton is expected to fall by around 200 rupees, could come in closer to around 900 rupees, around 880 rupees per ton. That's because of the modest price correction, seasonal cost uptick, as well as weaker operating leverage. Though on a year-on-year basis, the EBITDA per ton will look much better. The pet coke prices, they have started rising, but the full impact of this will only be seen in the fourth quarter. This could also set the stage for another price increase, which could effectively come in the second half of November itself. On the EBITDA per ton front, going by company-wise, well, UltraTech, the EBITDA per ton could dip to sub 1,000 rupees per ton. Shree Cement, with its focus on North India, it could clock the highest EBITDA per ton at roughly around 1,200 rupees per ton, while JK Lakshmi is expected to show strong improvement of a low base. However, Ramco's EBITDA per ton may improve by only around 120 rupees, but the overall EBITDA growth could be limited to just 15% growth because they'll be hurt by lower volumes. Well, from a valuation standpoint, while earnings momentum is strong on a year-on-year basis, well, investors will need to watch closely for sustainability of price hikes, volume recovery post the monsoon, and margin resilience as well, as fuel costs have hardened a little bit. Well, to help us out with how he's seeing the cement sector's numbers, we are joined by Dharmesh Shah, the research analyst at JM Financial. Hi, Dharmesh. Thanks a lot for joining in and good to have you on the show. Well, let's get to the profitability aspect first up, Dharmesh. The EBITDA per ton. Some brokerages are talking about 180 to 200 rupees per ton improvement on the EBITDA per ton front for the industry on the whole. What are you working with? If you could give us a rough number.
Sure. Good morning and thank you for inviting me to the show. So on a year-on-year basis for our coverage companies, we are expecting around 35% improvement in the EBITDA per ton, which is like broadly 250 to 260 rupees per ton. And this will be led by the 5 to 5.5% improvement in the realization on a pan-India basis, around 4% kind of volume growth and marginally lower cost on a year-on-year basis. But being this will be a seasonally weak quarter, on a sequential basis, we are expecting around 200 rupees decline in the EBITDA per ton, which is like 16 to 17% decline. And this will be mainly led by the price fall, which is around 1.5% sequentially on a pan-India basis adjusted for the GST and operating deleverage. So overall, we are expecting around 250 rupees improvement in the EBITDA per ton on year-on-year basis and around 200 rupees decline on a sequential basis.
Got it. Dharmesh, I want to ask you about the volumes. These numbers are going to look good on an absolute EBITDA, because of some price increases, benign input cost as well. But the volume growth is still not coming, Dharmesh. Gone are the days where we used to see 8-9% growth. Now we have to be satisfied with around 5%. However, there is optimism the second half of the year things will improve. What are the volume growth estimates you're working with for the industry on the whole? And do you foresee a recovery in the next 2 quarters?
Yeah, so generally we don't see both the things come together, volume and price. So the first half will be largely the price gain, where the industry has seen a 5 to 5.5% kind of price improvement. And despite the low base, the volume growth is likely to be just 4% in the first half. Given the base of the last year is also strong in the second half, where the volume growth has happened 8%. So in this year also, in the second half, we are expecting the volume to improve, and it will be like in the range of 7 to 8% volume growth for the second half. So on a full year basis, overall, we are expecting 5.5 to 6% volume growth versus earlier expectation of anywhere between 6 to 7%. So we are tapering down our volume growth estimate by 50 to 100 bips for FY26.
Okay, all right. Dharmesh, if we have to look at a positive surprise from this past quarter's numbers, if you could name a couple of stocks where you see a positive and maybe a negative surprise as well.
So I will say that the result will start from the 15th October onwards. But on a relative basis, the price decline in the northern market is relatively lower on a sequential basis. So Sri Cement in terms of the volume growth will be muted, but in terms of the profitability, unitary EBITDA, they can see a much better EBITDA per ton compared to industry and lower decline as compared to industry. Given that their focus is on the brand improvement side, and secondly, the north region had witnessed the lower price decline. So the north-based company can relatively outperform compared to industry, which is like Sri Cement. While on the other side, the southern-based companies like say Ramco Cement, where also the volume growth muted, but sequentially we have seen a higher price decline in the southern region. So the Ramco Cement kind of company can see a relatively higher decline in EBITDA per ton compared to industry.
Got it. Okay. So North will continue to do well, and South could lag a little bit just for the past quarter. I was wondering about the UltraTech Cement's commentary post the first quarter when they said that they believe South could be the new North, and they went ahead and then did that OFS on India Cements. That discussion for another time. But tell us, what are your top buy ideas and how do you position yourself? Some of these mid-cap companies, if consolidation has to continue, there could be some kind of M&A activity. So would you be staying with the top bosses, the big large cap names, or do you like some of these mid caps as well?
So see, this post GST cut rate implementation, and gradually we expecting that the next few months or the next couple of quarters, the industry will focus more towards the volume growth rather than the prices. So we will likely to bet on the large caps only. So we will prefer to go with the companies which are having a pan-India presence and the stronger balance sheet. So in the large cap, we will prefer the UltraTech, while in the mid cap space, we will prefer the JK Cement. And from a consolidation perspective, we believe that the large part of the consolidation is over. So we don't want to play consolidation theme for the next couple of quarters perspective.
Okay, all right. And on pricing, since that has been the positive for the last couple of quarters, I spoke about volumes, which are still lagging. But on pricing, at least the prices have held out, and in fact, they're marginally moved up. Even in the monsoon, we didn't see that kind of deterioration in prices. Now, X of this GST adjustment, what is the expectation with regard to pricing year on? Do you think for the remainder of the year, if these prices hold, will be good enough? Or are you factoring in a couple of price hikes as well?
So post GST rate cut implementation and second half can also see a good capacity addition. We are not expecting any material price hikes to happen. Rather, if the prices is hold on, that will be also be positive from the industry perspective. So we are expecting if any material price hikes to happen, it can happen only from the starting of the next financial year onwards. And we are not building any material price hikes to happen from here on for the next couple of quarters. And the industry may shift towards the volume side rather than the price improvement.
Got it, Dharmesh. Good to have you on the show. I think it's one of the first times that we're getting you. Thanks a lot for joining in and giving us your take on the cement pack. And we request you to join in once the results start flowing in and give us your first take on that front as well. So that's about the cement pack. Watch out for good improvement in terms of EBITDA. However, volume uptake needs to come about, and pricing, according to Dharmesh, if it holds steady as well, will be good enough in terms of an outcome. Well, we have Siddharth Rai who joins us back on the show to help us out with the technical call. Siddharth, good morning. Good to see you in on a Monday morning as always. The markets are down 80, 90 points thereabouts. The good news is at least we're not seeing deeper gashes, and it appears there is some kind of buying at lower levels. What would you do? Would you buy into this dip, or do you believe there is still some bit of a pullback?
Hi, Nigel. Good morning, and thanks for having me, first of all. See, if we talk about Nifty, Nigel, since the index is reacting to some unexpected global updates over the weekend, it is very crucial to see how exactly does the index price in this newly found information. So today's session in Nigel is going to be very crucial for the index, specifically in spot 25,200 is the level which we have to watch out for today. Yeah, we've seen the index playing zigzag above and below this level since morning, since opening today. So if the index manages to sustain back about 25,200 today in today's session, we'll be back on track to move towards those big 25,400, 25,450 levels. But on the other hand, if we fail to do so, if the index goes down and around those 25,150, 25,100 region, we can see a quick dip back towards those 24,900, 24,850 levels. So today's level is going to be today's session is going to be very crucial, and 24,200 is the level which we have to watch out for in today's session, because that will decide the move in index going ahead.
Thank you very much for that. Let's get Tata Capital's first stick. 330. So
wow, that's Chandra. Chandra, Chairman Tata Sons there, along with, of course, Mr. Sabharwal, the CEO of the company. So, I mean, that's saying something, right? Chairman of Tata Sons showing up for the listing of Tata Capital, and 330. It's about 1% higher. So, we should stay on the visuals, and big volumes, huge volumes. Rima.
Yeah, but this is the flagship financial services company of Tata Group, and Tata Sons participated in the offer for sale. So it was a very large issue of 15,500 crore, and it also included an offer for sale in which Tata Sons brought down their stake from 88 to about 74%. And Tata Sons chairman Chandra, he himself is present at the listing. It had seen an overall subscription of 1.95 times. In that, the retail participation was not gung-ho. It was fully subscribed by the retail 1.1 time, and the opening today is at 330, slightly higher than the 326 in terms of the issue price. This, remember, is India's third largest NBFC in terms of the overall loan book, which stands at about 2.3 lakh crore. It's been growing well at about 37% is the loan book CAGR over the last 3 years. But the net interest margins for the company are lower than peers. And that's because the company's focus is on perhaps lending more on the secure side. So the unsecured book as a percentage of overall retail is lower than the industry at 12%, which is why their NIMs are lower, but the credit profile, the return ratios have also been higher than peers. So it's sort of the approach of the management has been balanced towards risk and reward. And it's a stable opening for Tata Capital. That's the early tick on that. Okay, let's get back to the market technicals. Siddharth, you were giving us the index view. What about stock recommendations?
Yeah, sure, Rima. See, I think in this market, we should stay where the momentum is good. So when I say this, we should automatically move towards the autos. And right now, the auto stock which comes in my radar is Bajaj Auto. See, 9,000 was a very crucial level for this stock. For the past 2 days, we've seen a very good move, and it's back above the 9,000 level, and it's showing good momentum. So the move can definitely extend from here. Right now, the spot is trading around 9,056. So Bajaj Auto can be bought. The stop loss will be at 9,015, and our targets being the first target being 9,150, second target being 9,190. The second stock is Indigo. See, again, for the past 15 days or so, the stock is consistently showing good momentum to us. And right now, it's trading around a very crucial level of 5,800. And I think in some time, it will be able to go back above this level and sustain. So a fresh good move can be seen here as well. So Indigo can also be bought. Right now, the spot is exactly at 5,800. It can be bought. The stop loss will be at 5,779. And our targets being the first target is 5,890. Second target, 5,930.
Okay, all right. Thank you very much for that. Useful to get that perspective on those trades as well. Time for a quick commercial break here. Commodities back in focus. Manisha is here with exactly that.
Welcome back. Still down 100 on the Nifty, and the advanced decline ratio is firmly in favor of the stocks in the red. 800 stocks in the green for 1900 in the red. But let's talk commodities now. Manisha is here with us. Manisha.
Well, thank you for that. I want to talk about silver right now because we've seen a strong rebound in the Asian markets right now, so much so that we are holding around all-time highs on your screen, and that number should come to you. 51.5 is an all-time high that silver prices are at, and the MCX silver is trading at a discount of around 151 right now. But when you look at the spot markets, the ETF markets, those are trading at huge discounts. So when you look at the silver prices, when you look at the December 2025 futures, that is trading at 48.03. That tells you that silver is trading in a backwardation right now. So spot at 51.5 and December futures at 48 therein. If you look at the physical demand, that has been very, very strong in various areas, and that has been supported. The Indian silver premium also is trading at around 10% right now. So if you step out to buy silver today in physical markets, you have to give 10% premium for that. Well, various reasons for that, but let me come to the prices first of all. So in last 1 week, we've seen silver prices gain up by 6%. It's up 20% in last 1 month. And in one this year, we are looking at silver prices gain up by 78%. So huge gains coming in. This is the best yearly gain that silver has seen in a couple of decades now. Well, India is looking at strong physical demand, investment demand, physical festival demand as well. There is buying and there is a FOMO as well coming into the markets because silver, after breaking $50 an ounce, markets believe that you could be looking at higher highs. The fundamentals are quite supportive, and that is the reason you have a lot of buyers continuing in case of silver there. If you look at the overall markets then, and this is about MCX, remember the prices have been very volatile. So MCX as well, starting tomorrow, is revising initial margin requirements for gold and silver, both of those. So that is a circular that has come in, that came in on 12th of October, which says that gold initial margin now stands at 7%. This was 6% earlier. And for silver, it stands at around 10%, 11.5% right now. Earlier was 10%. So we've seen an increase come in for that one as well. That's about Indian futures. Take a look at the London silver now. For 4 decades now, it has been London silver that the world has been following, but that really seems to be breaking down right now. So London silver is trading at a $3 premium to New York right now. New York markets are trading slightly on the weaker side. There's a lot of arbitrage that we're looking at in the international markets also. The short silvers are struggling to source silver. People who've gone short, there's a short squeeze that seems to be happening at this point in time also. And the short silver holders are forced to buy record borrowing costs to roll positions to a later date. We also do understand that nearly an estimated 15 to 30 million ounces of withdrawal is what we've seen from New York. That has been the highest in last 4 years that a one-day withdrawal has come. And the expectation is that much of this silver really is coming in from New York into London there. Why is silver surging? Well, one, it is about the rising debt that we've seen in the Western world. The $37 trillion just in US is something that is mind-boggling. Devaluation of currencies is yet another factor. And then the US government budget standoff and finally shutdown entering a third straight week. The markets also are looking at strong rising demand from India in sense of festivals. The physical demand in India seems quite strong. At this point in time, the street is working with 5,000 to 6,000 tons of import of silver in this year. But that number could increase is what the markets are working with. And then apart from that, there's a falling supply of available bars to trade. The London inventories have declined by 25% when you look at the last 5-year chart there. So everywhere that you look, there is a deficit. The trading liquidity is nearly empty. The inventories have been declining. This is the 5th straight year of deficit. And the physical investment demand seems to be really surging, including India, where we are working with the premiums of around 10%. All of that keeping silver higher, and 51.5 is where we are trading, is an all-time high for silver yet again in the day today.
Thank you very much for that. Just one stock, MapMy India or CE Info. That's up 6.5%. And look at the volumes, 20 lakh traded in the first 1 hour of trade. The usual daily average volumes is about 50,000. And already it's seen 20 lakh. And earlier in the month, Ashwini Vaishnav, he had posted on Twitter when he was making a cabinet presentation, he spoke about the reliance on technology, and he said how this presentation was made by Zoho, the maps were by CE Info, CE Info Systems or MapMy India. So just once again talking about, self-reliance on technology. And since then, CE Info has quite shot into the limelight. Big move. Price and volume. Get into a break. On the other side is a special segment. It's the economy. Lata will chat with Rikin Shah of IIFL Capital on the banking sector outlook post the RBI deregulation and expectations from Q2 earnings.